The broadcast is now starting. All attendees are in listen-only mode.
It's good morning. Welcome to video's webinar on Safe Harbour and how to navigate through COVID-19. My name is Andrew Fielding. I'm one of the partners at BDO in advisory, and I'm the national lead for business restructuring. I have Shaun McKinnon with me, who's one of my partners.
Good morning, everybody. It's Shaun McKinnon here. I'm partner of Andrew's here within the BDO practice in Queensland. Just by way of introduction, I'm a partner in the advisory practice. My work is predominantly across corporate finance and business restructuring, and the Safe Harbour regime and how that affects businesses is something that we've started a lot of conversations with our own clients today. So we're looking forward to having a discussion across the course of this webinar about it.
We've had a number of questions as to how Safe Harbour is relevant at the moment with the amendments to the legislation. But we're seeing, we're in unprecedented circumstances where Safe Harbour was only something being considered by companies that were struggling, insolvent, or likely to become insolvent. But we now have a number of companies that were quite viable prior to COVID-19 that are looking at their cash flows and trying to determine whether they have a future. I guess our view on this is that the changes to the legislation in respect of director liability for insolvent trading only protects the directors in respect of one part of the legislation. There are a number of other obligations and duties of a director that Shaun will discuss a bit later on in the webinar. More importantly, whilst we have a Safe Harbour process and legislation, the process itself is probably more relevant than anything, in that the process is a structured process to put forward a plan which is then independently verified for the future trading of that particular business. And whilst the directors may not be personally liable, and it's an extremely good process in the current situation. So today, what we want to cover today is, I'm going to give an overview of Safe Harbour. We'll talk about the background and purpose. What are the preconditions to enter into Safe Harbour? What is the process and requirements? We'll then go into why we think it's an effective tool through COVID-19 and how the process would work and manage through COVID-19. We'll also talk about how Safe Harbour can influence restructuring outcomes and how Safe Harbour affects director liability and execution of directors' duties. So we'll start off with what is Safe Harbour. Essentially, Safe Harbour provisions were introduced into the Corporations Act to help businesses to continue to trade while a restructure occurred. Now, most of you will be aware that we have the voluntary administration legislation, which was introduced to promote the restructuring of businesses. However, that is an expensive process, and also the stigma that goes with the voluntary administration often prevents the business from being able to continue to trade. For example, if you're an engineering company or a building company, very few people are going to enter into a new contract with a company that is subject to voluntary administration or even a deed of company arrangement. And then at these uncertain times, they can't afford the risk that you're not going to be able to complete the contract at the end. So the legislation was introduced to give the directors the ability to put a plan in place to restructure the business, and whilst doing so, not be liable for insolvent trading. A number of the voluntary administrations that we've been appointed to, we've been appointed purely because the directors feel the liability or the exposure for insolvent trading. Whilst there was a reasonable plan moving forward, they themselves were not prepared to take on that liability. So, as we said there, as you'll see there in the slide, it's designed to encourage directors to seek a workout or a restructure rather than a formal appointment of a liquidator or a voluntary administrator. And it then gives them the protection they need. And people need to understand that it's not a protection for the company. What Safe Harbour does is provide a defence for directors in the event that ultimately the company becomes insolvent and a liquidator is appointed and looks at insolvent trading claims against the directors. So what Safe Harbour does is provide the directors with a documented process and evidence and therefore protection against an insolvent trading claim by a liquidator. There are, however, some preconditions that need to be in place prior to being able to enter into the Safe Harbour regime. For example, employee entitlements must be paid up to date and continue to be paid through the process. And the ATO lodgements need to be made on time when you've entered the Safe Harbour and through the process. So that itself, some of you may be aware that if your lodgements aren't up to date, then you can be held personally liable. That's the trigger by the ATO, not only for your BASs or your PAYG, but it's also applicable to things like superannuation. If your lodgements aren't up to date with superannuation, then you can be held personally liable for superannuation that's outstanding. Let's move to the next slide. So the requirements to enter into Safe Harbour and to have a well-documented plan, that you must you must be informed of the financial position of the company. You must then take steps to prevent misconduct that may impact upon the ability to pay debts. Now, one of the questions that we've already received prior to the webinar was, you know, is it unethical, or what are the ramifications of what are the ramifications of taking one of the government loans at the moment, knowing that you may not, or that you're insolvent and you're likely to fail in the long run? Well, so that's one of the things that we believe that directors should be aware of, because in our book that's going to be a breach of duty, and we consider that there's a very high risk that directors will be prosecuted for taking those loans in an event when it was clearly obvious that business was never going to continue. For example, particularly directors who are considering a voluntary administration regime prior to COVID-19. You know, I've heard discussions of those directors looking at applying for one of the government loans, notwithstanding they're already talking about going to voluntary administration. So the ultimate outcome, you know, for Safe Harbour is to try to come up with a better outcome for the company. So that's what it's got to be seen as a reasonable plan that will lead to a better outcome. So some of the other requirements are that you've got to maintain appropriate financial records. You've got to have advice from an appropriately qualified entity. Now, that may be a lawyer, it may be an accountant, but essentially what the reason for that is that, and we see it quite regularly, we presented with cash flows and projections, and the third party reviewing those challenges the assumptions that those cash flows and projections have been based on, and ultimately will sign off as to whether or not they consider that's reasonable. And by having that independent qualified entity do that, then it strengthens the reliability of the process in the case that it needs to be used as a defence. So the process is looking at the financial position, understanding what the future holds, developing and implementing and documenting a restructuring plan. So, you know, in a situation that you may consider that the company is insolvent, you know, you would go out and engage a qualified entity, usually a restructuring professional, who will then understand learn about the company's business and its current financial position. The entity would then ensure that the preconditions have been satisfied, because there's no point going through this if your entitlements aren't up to date or your lodgements aren't up to date, etc. The board has to then pass a resolution to enter into Safe Harbour, and from there it's a process of developing the turnaround plan, which will then provide a better outcome. And that's the test. It's a pretty general test, but the comparison is, if I prepare a plan, is this going to result in a better outcome than a liquidation. Now, the legislation is a little bit vague in respect of in whose regard is the better outcome. Is it the creditors? Is it the employees? Is it the shareholders? We've done a number of these Safe Harbour engagements where the better outcome has been the retention of the jobs by the employees and the fact that the company or the liquidator hasn't had to claim on FEG, which is a fair entitlement scheme, which pays entitlements if a company is unable to do so. If it's able to continue to trade and there aren't any claims on FEG, then we've argued that's a better outcome. So it's a fairly broad test. Once that plan's then developed, it's presented to the board, and the board must pass a resolution to adopt the plan. From there, the plan is implemented, and then on a regular basis, the plan is reviewed to identify whether or not you're achieving the objectives, and the plan can be modified as you move forward because no one knows what 6 months down the track actually holds. But each time it's modified, you go back to the same question: are we still going to achieve a better outcome if we continue down this plan? You exit the Safe Harbour when the plan has been achieved, and the board would then resolve that the company is exiting Safe Harbour. Now, the interesting parts to Safe Harbour is the notification. Now, whilst the board obviously has to pass a resolution, it's not something that is promoted outside the company's management. For example, a listed public company does not need to notify the stock exchange that the company has entered into Safe Harbour, which is an interesting debate because it's a fairly major change of circumstances that one would think would be a notifiable event. But if you consider it, if I was an entity that entered into Safe Harbour and I advised my major creditors that I'd entered into Safe Harbour, then it's unlikely that I would obtain further supplies from those creditors, purely of the risk that I was not going to be successful through the process. So it is quite unusual, but there is no notification to third parties of the process or the fact that the company has gone into Safe Harbour. So from there, we'll talk about why we consider this is relevant for COVID-19, and Shaun will take it from there.
Thanks, Andrew. So we've been through what Safe Harbour is and generally how it works. So now we wanted to talk a little bit about why this is relevant for COVID-19 impacted businesses. So obviously COVID-19 has created significant stress across the economy in businesses that until literally 4 or 5 weeks ago were otherwise extremely healthy and travelling along without any sort of financial stress. So this has led on to obviously potential insolvency risk, whether now or in the future, and also some personal risk for directors. So we don't know how long these conditions are going to last, but we do know the business will be impacted for some time to come. And experience has told us from dealing with companies through turnaround situations for many years that companies that act early and are proactive in terms of how they manage their financial stress and manage the plan on the way through that are the ones that will have the best chance of developing an effective turnaround strategy. And importantly, while there's been a 6-month moratorium provided for directors in relation to insolvent trading liability, there are in fact other directors' duties which are still in force and which arguably, and I'll talk about this a little bit further as we get down the track, but arguably if you are letting your company hopelessly trade insolvent without any sort of guidance or planning, you may very well be liable under some of those, even if you can't be pursued under insolvent trading legislation. So we might just flick over and talk a little bit about why is Safe Harbour relevant now in this environment? So, and why is it important in terms of how you manage through that? So Safe Harbour provides a formal framework for boards and management to follow that allows implementation of a best practice and externally supported turnaround plan. So at its very core, the whole benefit of Safe Harbour in our mind is about promoting a best practice restructuring environment. And while it was designed to be able to give directors protection from insolvent trading, And while it was also designed to promote that rescue culture, what we see in practice is, even outside of a COVID-19 environment, that it's a really effective tool to manage through any form of financial stress. It also gives directors the ability to use the Safe Harbour process and all the documentation that goes with that to demonstrate evidence that they've fulfilled their duties, not just in relation to dealing with insolvent trading, but also other duties that they have, which are commonly referred to as fiduciary duties. Now, if we just talk for a minute, we'll move forward and start talking a little bit about how does this work in practice at the moment. So let's talk through, imagine you're in a situation right now, which probably a lot of the people on this call are, that you're suffering from significant negative financial impact as a result of COVID-19. And as a board and management team, you're sitting there trying to determine how you move forward. The first thing that you need to do if you're thinking about Safe Harbour is obviously enter Safe Harbour. And that requires the directors to form the view that there is a risk to solvency either now or in the future. So if you're in that position, you need to obviously assess the solvency of the company. That can be done with external support, but I think in the current environment, the reality is that if you have concerns as a board and management that there is potential risk of insolvency, then that is enough for you to determine to enter into Safe Harbour. And that concern and that risk will be centred around whether or not you can pay your debts as and when they fall due, which is effectively the test under the Corporations Act of whether you're trading solvently or not. You need to consider the preconditions that Andrew talked about earlier, and they are employee entitlements need to be paid up today and ATO lodgements need to be made. Now, it's important to note your lodgements need to be made, but you don't necessarily have to have paid all of your ATO liabilities in full, but you do have to have made all your lodgements in time. Now, in the COVID-19 environment, there's obviously a few anomalies. So we've got situations where employees have been stood down. They may also be on JobKeeper. In terms of pre-qualifying for Safe Harbour, our view is that both of those scenarios would not preclude you from entering into Safe Harbour, and that we think you're still meeting those employee entitlements if you're in those scenarios. Now, the board, once they determine those preconditions are in fact met, will formally enter into Safe Harbour. That should be documented in the board minutes, file notes and records of advice. And the other thing that I've just put on the slide, which you should think about, is consideration should be given to whether or not there are disclosure obligations in any director and officer's insurance policies. Is one that you should just at least review before you take that step. So you've entered Safe Harbour, and now that you're in Safe Harbour, the next step is to actually formally develop a restructuring plan to ensure that the Safe Harbour is effective. So a formal restructuring plan must be developed and implemented, and that plan has to improve the financial position of the company, and it has to be able to pass what they call the better outcome test, which is that the plan has to reasonably lead to a better outcome for the company's financial position. Now, the legislation isn't prescriptive at all around what that means, but our view is this. These are sort of some of the elements that you would need as a minimum to be within that plan for it to hold up to scrutiny down the track if it was required to do so. And certainly from a practical perspective, these are the things that we think that you need to be able to do and demonstrate to make sure that, most importantly in these scenarios, that your business is in the best position to be able to effect a turnaround situation. So first and foremost, you need to be able to evidence what negotiations and plans you have made to deal with key creditors. These will typically involve standstill arrangements or something similar. Now, at the moment, we've got things like the Tenant and Landlord Code of Conduct that's been released. Different governments are moving those into legislation. State governments are moving that into legislation as we speak. We saw the Queensland government do so in the last couple of days. Obviously, that particular piece of legislation doesn't give, if you're across it, a lot of detail of this other than details of the powers that the government has to influence certain tenant and landlord negotiations. But your plan would need to clearly demonstrate looking at how you're going to deal with all of those types of issues with key creditors. Your plan would also need early engagement with your financiers. And really, this is critical. In any turnaround situation, having support of your financiers is a key part to getting a successful outcome. And certainly in the COVID-19 environment, we have seen financiers have been extremely supportive of businesses. They've released a series of measures designed to assist cash flow through this period. So I suspect that if you are in a position at the moment where you're dealing with these types of issues, any assistance or any attempts to engage with your financier earlier will be positively received. Now, most importantly, the core of any good turnaround plan, and certainly any safe harbour plan, is a robust financial forecast. And that forecast has to be based all around the cash flow outcomes. Now, in our view, the forecast must demonstrate that the business can trade through on a cash flow basis. Now, there's a lot of people that have said to us in this, where we're having conversations around Safe Harbour at the moment, a lot of the discussion we've had has been, hey, we're in this extraordinary trading period. How am I supposed to be able to demonstrate what my forecast is going to look like over the next 6 to 12 months, let alone, well, the next couple of months, let alone the next 6 to 12 months? And look, it's a really good question. What we're talking to our clients about and what we're telling people is, all you can do is make your assessments around those assumptions supporting your forecasts on the best available information to you. And if you're trying to make sure that you qualify for Safe Harbour, you need to properly document that decision making and the evidence that you use, and you need to keep updating it regularly. It's definitely a challenge working through this period, but that's the way we think that it should be dealt with, certainly at this point in time. Another thing that I think is incredibly important is you need to include in your plan a financial analysis that demonstrates that you've looked at the difference between an insolvency position and what your plan will do. And the way you would typically look at that is do an assessment of what would happen if you had to appoint a liquidator today. And in most cases, that will crystallise a series of liabilities. It will create a situation which is almost certainly for a distressed business to end in a less than 100 cents in the dollar outcome. However, you then compare that to the plan that you put in place. And the very nature of these plans is that they are designed to be able to get you to trade through and be able to keep solvency at the end of this, even if you go through a period where you may not be. And it will be necessary to be able to demonstrate that you can traverse that potential insolvent period. And by virtue of demonstrating you can do that, then all creditors would be in a position where they would receive 100 cents in the dollar and nobody would lose, and hence you could demonstrate quite clearly that it's a better outcome than insolvency. You would typically have in your plan a series of measures and milestones, those which result in the financial forecast being achieved. So you've got your forecast, it's got a series of assumptions, you then have a plan that sits off the back of it that usually is a bit of a timeline. It says here are the things that I need to do. It might say, for example, I'm going to negotiate a period of rent relief and it's going to be this. That's what I put into my forecast. I'm going to achieve it by this date. Those things are important because you need to be able to help. You need to be able to hold yourself account to that, because as you move through this process, it's important to be able to continually check in that you're meeting those forecasts to A, make sure that the business is heading in the right direction, and B, make sure you have the protection Safe Harbour. Now, once you've got your plan in place, it's important, and it's prescribed by the legislation, that you need to get an appropriately qualified entity to be engaged to provide advice on that plan. Now, in practice, some of the Safe Harbour engagements that we have worked on and that we are working on really involve you engaging that party before the plan is developed and giving some guidance on it. But for the purposes of the legislation, you certainly need that plan to be signed off, and it has to pass the better outcome test. Who should be your advisor? Again, what is in the slides is all it says in the legislation, that it has to be an appropriately qualified advisor. But it's fairly reasonable, I think, to assume that where you're dealing with a restructuring and a turnaround scenario, that you need to be able to demonstrate that the advisor had experience in restructuring and turnaround. And hopefully most of the people on this call have never had to understand that there is quite a detailed industry around that. But there is, in fact, a number of industry professionals, both across the legal and accounting practices, that specialise in this type of work and what we would consider to be appropriate to sign off on that plan. Now, the sort of things that that advisor is going to ask to see when signing off on your plan will be things like evidence of the negotiations with creditors and financiers. So it's not going to be enough that you simply said, it's not going to be enough that you simply said in your plan that you are going to negotiate a 6-month repayment holiday from a particular financier, for example. You would need to be able to demonstrate that you had taken steps to do that. And that might be file notes of conversations, or even better, correspondence evidencing that. The assumptions that support those financial forecasts 100% need to be clearly articulated and provided to your advisor. They're going to have to form a view as to whether or not those particular assumptions can in fact be realised. And having assessed those assumptions on a collective basis, then understanding whether or not your forecast as a whole can be achieved. The advisor is going to need to see what your measures and milestones are, understand how they fit within the plan, and understand whether or not they are reasonable. For example, it might say in your plan that you're going to ask for your landlord to give you a 100% reduction for 6 months. And the only way your forecast works is if you get that. But if you can't demonstrate that you've actually had some preliminary discussions with the landlord, I don't think any reputable advisor is going to be able to sign off on that particular plan. And finally, with the benefit of all that work and reviewing all that information that you've provided to the advisor, they're going to need to be in a position where they can then form a view that that plan is reasonably likely to lead to a better outcome than the appointment of administrator. And to do that, and I'll hark back to what I said in the previous slide, to do that, you're going to need to be able to consider and preferably demonstrate to them what you think it looks like if you had to appoint a liquidator today. It's very powerful evidence to be able to demonstrate both to an advisor now and to anybody that might come knocking on your door if the worst does happen, that there was a very good reason for you to progress the business as a going concern and pursue a positive trade out, because there were in fact a disaster scenario if you didn't.
Shaun, I might just add an example. One of the Safe Harbour plans that I reviewed was for an entity that was turning over $40 million, and they owned a lot of real property. The whole Safe Harbour plan was based on them realising that property and the financier taking less than their payout on each of the properties. The interesting thing was the financier had not even been consulted through the whole process. So the plan was never going to, was not sustainable, and it wasn't a workable plan because they hadn't brought their financier to the table and got them to agree to taking a reduced payout.
Yeah, and that's a great point. I think the reality of any sort of COVID-19 workout plan at the moment has to be based on supply chain collaboration. So all the different participants in your supply chain at the moment have a lot of goodwill to keep you going through difficult times. And the general concept of continually being collaborative with the people in that and very transparent around exactly how you're going to work through things, why you can't pay certain things or why you're looking for discounts, will give you the best chance of getting an outcome. So let's move forward in terms of how this practically works. So you've developed your restructuring plan. You've now had your external advisor review it. They may have helped you develop some of it, but ultimately it is your plan as a board and directors. And you now have to formally adopt it. And we recommend that the board should formally adopt that. It should be included within the minutes. It should be included that they have recorded the advice from the advisor regarding the better outcome test. And for my way of thinking, what we've been advising clients to in this is, we think it's important to really demonstrate that the reason this plan is coming into play is because of COVID-19 impacts. Because one of the other things to keep in mind here too is insolvent trading moratorium that is out there at the moment for directors, it only exists from the point of time that that legislation was passed. So if you're potentially insolvent coming into this, it's not a cure-all, and you're still potentially liable for insolvent trading and debts that accrued pre this, and potentially some that accrued during it, which I'll talk about shortly as well. But I think that's an important distinction to make in your board minutes, that the reason for this is the COVID-19 outcome rather than necessarily something that occurred before that. So we've adopted the plan, and now it's also critical that you continue to implement and monitor that plan. So once the restructuring has started, that's really the start of this point. It's not actually developing the plan. Shouldn't be a tick the box exercise. It needs to be a live document that has ongoing monitoring. And this is really critical. You have to monitor that against your forecast, because we are in an environment, as we all know, that right now is changing, most recently almost week to week. And while it seems that most of the government support measures have largely been released now, and that over the next coming weeks and months, as some of those cash flow benefits, the cash boost, JobKeeper payments, negotiations between landlord and tenants, some of these turn into actual cash in the bank or moratoriums on payments, we're going to see a changing environment moving forward too. But it is critical in that environment to continually monitor that forecast. And at the moment, we would expect you to be updating that every week and making sure that anything that's changed, any developing situations are taken account of, and that continues to be tested against the better outcome test. All right, so I'm going to talk just for a little bit about how does Safe Harbour affect director liability. So the Safe Harbour process, in our view, is just good corporate governance practice, and it demonstrates execution of a range of director duties. And when I say that, I'm talking about, I know the concept of Safe Harbour was always designed to be able to give you protection from insolvent trading, but in actual fact, I think it gives you a broader protection if you do it correctly. And while I'm not a lawyer, I'm not giving you legal advice, obviously. I'm thinking about it from the perspective of a registered liquidator, of which both Andrew and I are. And in our job, when we are appointed as a liquidator, one of our statutory duties is to be able to review the reasons for the company's failure. And we have to investigate what potential actions the company may have against, amongst other people, the officers and directors of the company. And certainly from our perspective, when we do that, we investigate insolvent trading, but we also investigate all of those other directors' duties. And those are, ones I've nominated there around things like care and diligence, good faith, etc. And the same set of facts that we would typically prosecute someone under an insolvent trading legislation are often the same set of facts that we use to prosecute directors under those other sections of the Act as well. So for that purpose, I think the Safe Harbour process, it demonstrates a really effective tool for directors to be able to demonstrate not only are you doing everything you can to develop an effective restructuring tool, but you are doing it in a way that also demonstrates that you're really executing a lot of those other directors' duties as well. So a few things here to consider. Now, Safe Harbour will give directors clear insight. Safe Harbour is obviously giving you a 6-month, the government's giving you a 6-month insolvent trading holiday, liability holiday, but there are a couple of exceptions to this current legislation. First is the legislation that was released in the last couple of weeks says that directors are excused from insolvent trading liability in relation to debts that are incurred in the ordinary course of the business. Now, you might want to, if you're relying on this position, you might want to take legal advice, but the inference, I presume, is that debts incurred outside the ordinary course of the business, you will not necessarily be protected from insolvent trading on. Certainly that's something that you'd want to talk to your legal advisors about if you are relying on that insolvent trading moratorium at the moment. And of course, egregious cases of dishonesty and fraud, they will still be subject to criminal penalties. And so again, I think we touched on this earlier at the beginning of this webinar. This is not a free pass to just completely trade the business in a hopelessly insolvent environment. If that's the case, I think directors will find themselves potentially in some difficulty down the track. Now, Safe Harbour will give directors a defence in the normal instance of insolvent trading, as we know. And obviously, if you're in Safe Harbour, you're going to have protection as you come out of the COVID-19 period. In our view, and it seems to be from talking to a lot of our clients, and we have had literally back-to-back phone calls and video conferences with clients of our firm over the last 3 or 4 weeks around solvency and managing through and turnaround plans and all that sort of thing. And the general consensus seems to be within our client base is that the difficulty for a lot of businesses is going to get greater as the sum of these moratoriums start to wear off. So in 6 months' time, for example, say you've enjoyed some of the moratoriums that are available, like the employee entitlements, sorry, the payment of your bank debt, which has been waived potentially for 6 months. Those liabilities still exist, remember, at the end of 6 months. They're not being waived. If you've been able to defer some of your rent, some of it may have been waived, but under the code of conduct, a lot of it has to be deferred, some of it has to be deferred. That'll still have to be repaid. If you've been deferring payroll tax, well, I think that comes payable again back in August if you're in Queensland. If you've been able to gain a deferral of some of the ATO liability payments that you've accrued, while there isn't a specific time frame on that, you still need to pay them at some point. So the issue, I guess, is that you need to be taking account of what's happening now and how that's going to impact you once this insolvent trading holiday materialises in about 6 months' time. And I think technically it was the 25th or the 26th of March government passed the legislation, so we're talking 6 months from that is effectively, what we'll call the cliff. So I guess moving on then, so how does Safe Harbour influence restructuring or survival efforts in this environment? And look, this is really at the core of this whole presentation, which I hope is coming through, which is Safe Harbour necessarily promotes a positive, structured, supportive approach to working through financial distress that promotes business survival and is a complementary risk management tool for directors at the same time. This is really the whole purpose of what we're talking about today. Is Safe Harbour might be there to give you that protection. It might have been originally anticipated as a tool for directors to keep them working through business rescue efforts so they have comfort that they don't actually have insolvent trading liability. But the real benefit, the true benefit to us, is entering into a formal restructuring process. And we deal with businesses that are going through this all the time. And unfortunately, we have to deal with business at times that have actually failed and gone into liquidation. And the common theme amongst a lot of those businesses that we deal with is that they didn't pre-plan. They didn't have a formal way of dealing with this. They didn't reach out to advisors that could help them through this process. And before they realised they needed the help, it was too late. And if you follow a Safe Harbour process, that process alone demonstrates a really effective tool for you to be able to get your business through this process. And hopefully you don't need to ever rely on the protections it provides, but if you do, there is a lot of utility in having run this process from that perspective as well. So that sort of covers off, I guess, the main stuff that we wanted to talk about. I just wanted to touch briefly though on what happens if 3 or 4 months from now, you've entered into a Safe Harbour process, but it isn't working. So the reality is this: we've talked about the fact that you need to be continually reviewing your plan as it goes through. You need to do that to make sure the company's in the best shape to be able to trade through this position. And you need to be able to continually update what's occurring to be able to understand whether or not that situation is changing. And if it becomes apparent to you that the business is in a position that it is going to be insolvent at the end of it, and that it's not going to be able to trade out, then you need to have a look at what the alternatives are. And those alternatives obviously are looking at insolvency processes. Now, the worst case obviously is if you are hopelessly insolvent, that you need to consider the appointment of a liquidator. However, I just wanted to put on the radar the fact that the voluntary administration process is also an effective tool to be able to manage through and do a proper restructure of a business that may have been impacted by COVID-19 results, and the losses that have accrued during this period may have put them in a position where they are insolvent and they can't reasonably trade out of it, but that they still have an underlying core business that is potentially profitable on the other side of this. And we've seen, more recently, just in the last couple of weeks, obviously Virgin have taken this route. There's been a couple of other high-profile businesses that have in the retail space, such as Colette, that have gone through that process as well in the last few weeks. And while nobody would ever really likes to consider having to use the prospect of any type of external administration, it is a very real way, if you do have that underlying core business that has been impacted purely by the impact of COVID-19, it is a very real way for you to be able to keep the businesses alive and restructure to come out the other side if you can't do it through a solvent process.
And Shaun, I think we'll see a number of businesses that have been struggling prior to COVID-19 taking the opportunity to enter into a voluntary administration to restructure their debt and come out stronger. I think Virgin's a very good example. Virgin had not been profitable. You know, it's got $5 billion worth of debt. It is likely to come out in a restructured form with a substantially lower amount of debt. So I can see a number of companies taking the opportunity of avoiding the stigma of going into a voluntary administration because of poor trading or bad management, utilising the circumstances created by COVID-19 as an excuse as to why the company needs to be restructured. Everybody's in the same position, and they'll be utilising the voluntary administration process to restructure and come out of this in a far better financial position. The other comment I might just make before I recap, Shaun and I were talking about this just before the webinar. One of the pieces of legislation which hasn't been amended to date is the preferential payment legislation. Now, some of you may not know that well, but essentially, if a company goes into liquidation, a liquidator will look at the payments that have been made in the 6 months prior to the winding up petition and determine whether or not someone's been paid over and above anybody else. Now, the interesting situation is going to be in the current scenario of businesses only paying critical suppliers and not everybody just to get through. Now, to us, if they ultimately fail, then at this stage, we've seen no government intervention that is going to protect those suppliers for being pursued for preferential payments. So thinking through that, if I was a supplier, I would certainly be looking for my customer to provide me with a plan and documented proof that they have reached agreement with their bank, their non-core creditors, etc., etc. So the thing about insolvent trading or a preferential action, a preference is only available if the company was insolvent at the time the payment was made. The definition of insolvent is that you cannot pay your debts as and when they fall due. The moment you reach an agreement with a creditor to defer payment, you are no longer potentially insolvent in regard to that particular creditor. For example, if you've got an outstanding debt with the ATO and on the face of it you look like you're insolvent, if you enter into a repayment program with the ATO, then you are no longer deemed to be insolvent. So as a supplier, I would be looking at my clients to prove to me that they have a plan in place, they have reached agreement with their creditors, and they have a way of moving forward. Because whilst you might be doing the right thing now, any payments that you receive, other than payments being for new and fair consideration, and that is essentially that you would virtually have to be paid COD for what you're providing, you are at risk in 6 months' time or 8 months' time of being pursued by a liquidator for a preferential payment. So I think there's a lot, the process of Safe Harbour does a lot more than just provide directors with a defence in the event of insolvent trading. Because it puts together a documented formal plan on how to move forward, all those parties that you deal with will get some comfort that you are thinking about it, you have planned through it, and you have a plan moving forward. So just another thought in respect of the process itself. So just to recap, today we've been trying to very briefly give you an update on what Safe Harbour means, what the background is, the purpose, and as I said, we believe that the purpose can be broadened from being a defence to being a very, very good management tool, and the process itself is we're just taking that and adopting that and saying it has other applications. We've described what the preconditions are. I mean, if you're going to go through this process, you may as well ensure that your preconditions are in place in the event that in 6 months' time and the moratorium on insolvent trading is lifted, then you can put your hand on your heart and say, oh, I've got a defence, I've done it the right way. We've been through what the process is and what's required, why we think it's a relevant tool to manage the impacts of COVID-19, how in practice Safe Harbour could be implemented, and how it would influence a restructuring outcome. So, and then we've also talked about how we believe that directors still have an ongoing liability for the numerous obligations and duties listed in the Corporations Act by putting together a Safe Harbour plan. So that's about all we've got for today. So we're very happy to take questions or anything we've raised.
Yeah, we've got a few here already. So there is a questions section within your webinar panel if there's any more, so we'll still open up if you wanted to lodge some more, do it through that. But let me go through the ones we've got so far. So the first question was, with a 6-month moratorium on solvent trading claims against directors now, what more protection would a Safe Harbour regime give to a director? This actually came in before the presentation. Happy to take that one. So look, I think we've probably covered that off during the course of the presentation, but again, in summary, our view is that there are directors' duties outside of those related to just insolvent trading, and the Safe Harbour process gives directors a good opportunity to demonstrate compliance with other fiduciary duties, is our view.
One of the other questions we received prior to the webinar was, what is the position with JobKeeper in the event that the employees are subsequently terminated? Our understanding, and certainly is something that you should get independent legal advice on, is that because JobKeeper is paid in arrears, if an employee is terminated, you then cannot apply to be reimbursed for those wages because it's for the purpose of JobKeeper. The other sting in the tail of this is if that employee was to go off and get a job somewhere else, that employer cannot seek JobKeeper payments for that employee. So and the third part being that any monies that you have received in respect to JobKeeper, they're not repayable in the event that the employee is ultimately terminated. So that was another question that we received.
I've got another one here. The Commonwealth has announced 3-year unsecured loans up to $250,000. Are these available for not-for-profit entities? Question. And then secondary question, what ethical obligations apply to directors in entering into such a loan? For example, if the business income stream is unclear before they repay the loan. Andrew, did you want to address that one?
Yeah, look, once again, the legislation does cover not-for-profits, so it is available for not-for-profits. But as we've tried to point out in the webinar today, there are still a number of director duties that are capable of being breached, and in our view, to obtain one of those loans, I think you would have to be providing misleading information if you were aware that the company was insolvent, and it was very unlikely that even with the funding from the government, the company was not going to continue. So I think that there's certainly a very strong argument that you would have breached your duties as a director of incurring a debt at a time then when you knew that the company was unable to make that payment.
Another question here. In what ways, if any, do you see the new temporary Safe Harbour from liability for insolvent trading being exploited by businesses with fatal weakness in their financial position and prospects? I'm happy to take that one. So, look, I think it's a risk, obviously, and I think Andrew touched on this earlier today, that businesses coming into this that might have been in a little bit of stress certainly shouldn't see this as a free pass to continue on where ultimately there really is little hope. I suspect that there will be a number of businesses that enter into this that were in a difficult position, or even those that potentially, depending on how long this goes, probably trade a little bit further than they should have. So look, there is a risk I see in that. For businesses entering that phase, my advice would be, and we've talked about this in the presentation, you need to critically look at the alternatives. Just because you are becoming insolvent doesn't mean that particular business is necessarily doomed. There are other things that you can look at outside of Safe Harbour to restructure a business, and that being primarily voluntary administration. And that is an effective tool where that underlying core business can be demonstrated to be profitable, subject to getting necessary agreement from your creditors, of course, but that is a potential tool that you can look at. And I don't think businesses should rely on this 6-month period to just continue trading and hope for the best, because they may miss an opportunity to do a genuine restructure if they take that approach.
I think the other part of that question was predatory behaviour, and yes, we are seeing that. We are being inundated by inquiries of opportunities for distressed businesses by private equity firms, etc., etc. And I think that the 6-month moratorium on direct or insolvent trading is giving them the opportunity to be able to make an offer, take over an operation, and not be personally liable for insolvent trading while they do a restructure. Ultimately, it may be the case that they do put the company into a voluntary administration, but ultimately come out the other end with a business that is quite valuable, that they have not paid as much as they would have 6 months ago. So we are seeing that. As I said, we are seeing a lot of inquiry from entities that do have working capital that are on the market looking for those opportunities. I think we're probably going to see a lot of that in the hospitality and tourism industry. There's a lot of those operators being closed that they can only get limited funding from their banks, and I think there's going to be a number of players looking at picking up assets at a bargain basement price, using the fact that they're not going to, by taking over, they're not going to be liable for insolvent trading, and ultimately, I guess, rolling the entity into a voluntary administration.
All right, that looks like all the questions we've got. So.
No. Yeah.
So look, that really ends our webinar today. So I wanted to thank everybody for attending and giving us your time. If you are in a situation where Safe Harbour is something that you want to consider, the contact details for both Andrew and myself are on the slide presentation, and we'd be happy to talk to you if you'd like to reach out to us. So thanks very much for your attendance today, everybody.
Yes, thank you.